Imagine waking up one morning to find out that a crucial support beam in the foundation of your house has quietly rotted away. No crashing sounds, no dramatic warnings, just a silent decay happening underneath your feet. That's exactly what's happening right now in the financial world, and most Americans don't even realize it. While headlines scream about political battles, celebrity gossip, and the latest tech trends, a quiet financial earthquake is unfolding, one that could reshape our economy in ways we haven't seen in generations. China, without a single press conference, without a single sanction, has decided to freeze nearly all outbound investments into the United States. No debate, no warning, just a silent but decisive shift, orchestrated deep within its government agencies. At first glance, it sounds distant, even abstract, like something happening in some faraway boardroom. But the shockwaves are already rippling through Wall Street, through Silicon Valley, through neighborhoods just like yours and mine. And the truth is, this isn't an emotional reaction. It's not retaliation in the way we usually think about it. It's a cold, strategic move, one that's been quietly building for years while most of us were focused elsewhere. Today, I'm going to take you behind the headlines. We'll explore how this silent maneuver is exposing cracks in the American economy, how it's accelerating a historic shift in global finance, and what it means for you, for your investments, and for the future we're all stepping into, whether we're ready or not. So grab a coffee, settle in. This isn't just another story about politics or Wall Street drama. This is about understanding the currents beneath the surface and learning how to navigate them before they pull us under. Let's dive in. It's easy to look at today's headlines and think, this came out of nowhere. But the truth is, it didn't. This moment, this quiet financial earthquake, was set in motion years ago. Let's rewind the clock to 2018. That was the year when tensions between the United States and China really started heating up in a way we hadn't seen in decades. It wasn't just talk, it turned into action. Waves of tariffs, sanctions, and an escalating trade war that quickly shifted the landscape for global business. Back then, it seemed like a bold move. I remember people saying, finally someone's standing up to China. And in some ways, it did feel necessary. There were real concerns about unfair trade practices, intellectual property theft, and growing imbalances. But here's the thing about battles. You have to think 2, 3, even 4 moves ahead. And somewhere along the way, we stopped playing chess and started swinging wildly. By late 2018, Chinese investment into the U.S. had already started to collapse. According to the Rhodium Group, a leading research firm, Chinese direct investment in the United States fell by over 88% that year alone, from a peak of $46 billion in 2016 to just under $5 billion in 2018. That's not a typo. Imagine losing 9 out of every $10 you were counting on for your business. For startups, real estate developers, and even major corporations, that was devastating, and the worst was still ahead. What's striking is how quietly it happened. No big headlines, no emergency alerts. It was a slow, steady withdrawal of capital, like a tide going out before a tsunami. In my view, this wasn't just about economics. It was about trust. And once trust starts eroding between two economic giants, it's incredibly hard to rebuild. You can't just flip a switch and say, we're friends again. Capital moves to where it feels safe, respected, and welcomed. And by 2018, the message China was receiving from the US was loud and clear: you are not welcome here. Now, a 95% drop in investment isn't just a number. It's a symptom of something deeper. It shows a relationship that's fractured and an economic system that's far more vulnerable than we like to admit. If we had paid closer attention back then, maybe today's freeze wouldn't feel so shocking. Maybe we could have anticipated the aftershocks before they started shaking the foundation. But hindsight, as they say, is 2020. The real question now is, how exactly did China manage to freeze almost all remaining investments without triggering a massive backlash? That's what we're about to unpack next. Let's keep going. Sometimes the biggest moves aren't the ones that make the loudest noise. They're the ones you barely notice. until it's too late. That's exactly how China pulled off one of the most effective financial moves we've seen in years, without a single major headline at the moment it happened. Instead of holding a press conference, slapping on new tariffs, or announcing sweeping bans, China chose a different tactic: quiet, relentless bureaucracy. Here's how it worked. If you were a Chinese company in, say, 2016 or 2017, and you wanted to invest in a tech startup in Silicon Valley, it was a relatively straightforward process. You applied for foreign currency approvals through the State Administration of Foreign Exchange, SAFE for short. You got your permission stamped, moved your money, signed the deal, and boom, you were in business. But today, that process has quietly turned into a maze. Applications that used to take weeks now take months, or they just disappear into a black hole of pending review. In many cases, companies aren't even getting formal rejections. They're simply left waiting, indefinitely. And it's not just happening to risky tech investments either. It's across the board. Real estate, manufacturing, even clean energy projects that once attracted billions. One example that really stuck with me was a Chinese investment group that planned to inject $300 million into a major renewable energy project in Texas. In 2019, the paperwork was moving along smoothly. By 2021, the deal had vanished, caught in an endless loop of regulatory processing with no clear reason why. And when reporters tried to get answers, both the investors and the regulators gave the same response: no comment. It's frustrating to watch, honestly, because from the outside, it looks like nothing is happening. But inside those companies, inside those boardrooms, there's panic. Projects get shelved. Jobs that would have been created simply don't materialize. Innovation stalls. In my opinion, this strategy was brilliant precisely because it was invisible. There's no public fight to rally around. No lawsuit to challenge. Just silence. And the slow, steady suffocation of a key capital flow into America's economy. And the best part, from China's perspective, by acting quietly, they avoided sparking an immediate diplomatic firestorm. No dramatic retaliation, no tariffs flying back and forth, at least not yet. The effects, however, are very real, and they're multiplying. Without that steady stream of foreign investment, American businesses are facing tough choices, and those choices will only get harder in the months and years ahead. But what exactly does this mean for the everyday economy? How are startups, real estate developers, and even big corporations feeling the squeeze right now? Let's take a closer look. When the money stops flowing, the cracks start showing. And right now, those cracks are turning into deep fractures across parts of the American economy that many of us once believed were unshakable. Venture capital, the lifeblood of innovation in the United States, is drying up faster than anyone expected. And you can trace a good chunk of that back to the quiet financial freeze we've been talking about. Think about it. For years, Chinese investors were major players in funding American startups. From clean energy tech in California to biotech hubs in Boston, their capital wasn't just extra money. It often made the difference between an idea staying a dream or becoming a billion-dollar company. Take, for example, a clean energy startup in San Diego I recently read about. They had cutting-edge technology that could have drastically improved battery efficiency, a game changer for electric vehicles. They were deep into negotiations with a Chinese-backed venture firm in early 2020. And then, silence. The funding fell through. Their Series B round collapsed. They laid off 40% of their staff and eventually had to license their patents to a larger corporation just to stay afloat. And that's just one story. Multiply it across hundreds, maybe thousands of startups, and you start to see the bigger picture. Without that influx of foreign capital, American startups are being forced to turn to other funding sources. And let me tell you, those options aren't nearly as friendly. High-interest debt, predatory venture terms, private equity firms demanding massive equity stakes just to keep the lights on. It's like moving from a supportive bank loan to a loan shark offering you money with a baseball bat hidden behind his back. And the worst part, this pressure isn't just crushing young companies. It's stifling the very spirit of innovation that has always set America apart. In my own conversations with founders lately, I hear the same things. Everything is harder now. Investors are way more cautious. Big ideas just aren't getting funded like they used to. And it's not just tech. Real estate projects that once depended on international investors are also stalling out. Commercial developments in cities like Houston, Miami, and Los Angeles are sitting half-finished because the capital simply isn't there anymore. You might not see it in the headlines every day, but walk through parts of downtown in any major city right now and you'll feel it. The energy is different. More empty storefronts, more for lease signs, more dreams deferred. In my opinion, what we're witnessing isn't just a temporary market hiccup. It's the start of a deeper, more systemic shift. And unless new sources of capital emerge or the system fundamentally adapts, we're looking at a long, tough road ahead. But even as America struggles with this sudden drought of investment, China isn't just sitting back watching. They're moving their money elsewhere, quietly building new economic bridges that could change the global map. In the next part, let's explore exactly where China's capital is going and why that should matter to every single one of us. Let's dive deeper. When one door quietly closes, another one often swings wide open. And that's exactly what China is doing right now, stepping through new doors that most of us haven't even noticed yet. While investments into the United States have slowed to a trickle, Chinese capital isn't just sitting idle. It's moving, strategically, intentionally, into new markets that welcome it with open arms. The biggest winners? The ASEAN countries, nations like Vietnam, Indonesia, Malaysia, and Thailand. Places that are booming, modernizing fast, and eager to strengthen their economies without the geopolitical baggage that comes with American partnerships these days. In 2023 alone, China poured over $120 billion in direct investment into ASEAN markets, according to the Asian Development Bank. That's a staggering number, and it's only accelerating. I recently spoke with a friend working for a multinational corporation that relocated its entire supply chain from China to Vietnam. You'd think that would frustrate Beijing, right? But instead, Chinese investors are right there too, building factories, funding tech hubs, and setting up financial infrastructure. They're playing the long game, still part of the value chain, just in a different way. And beyond traditional investments, China is quietly building a parallel financial universe through the digital yuan. It's not science fiction anymore. Transactions across borders in Africa, in Southeast Asia, even pilot programs in Europe are already being settled in China's digital currency. No dollars, no SWIFT system, no Western oversight. I believe this is one of the smartest plays China has made in decades. While many in the West still debate blockchain theory or get stuck in regulatory red tape, China is already rolling out real-world applications, ones that could, over time, seriously weaken America's financial leverage globally. When you look at the big picture, it becomes clear why ASEAN is suddenly more attractive than the US for Chinese capital. Faster economic growth, lower political risk, easier regulatory environments, and perhaps most importantly, no ongoing Cold War dynamic hovering over every business deal. In my view, the United States still has massive advantages: deep capital markets, world-class innovation, a culture of entrepreneurship. But the playing field is shifting, and if we assume that dominance is permanent, we're making a dangerous mistake. Because while we're stuck in yesterday's battles, China is already sketching out tomorrow's map. And as they expand their influence and strengthen new alliances, it's crucial we also ask, what risks are they carrying inside their own system? Because no strategy, no matter how well planned, comes without a price. In the next part of our let's take an honest look at the challenges China is facing beneath the surface, the ones they don't advertise to the world. Stay with me. Every great strategy looks flawless from the outside until you peek behind the curtain. And while China's financial moves seem calculated and precise, there's another side to this story that doesn't get nearly enough attention. Because here's the thing, no system is bulletproof, and no strategy is risk-free, not even China's. Let's start with the elephant in the room: debt. For years, China's growth has been fueled by massive borrowing, particularly in its real estate sector. Remember the headlines about Evergrande, one of the world's largest property developers, once worth hundreds of billions of dollars, now drowning in debt and defaulting on loans left and right? That wasn't an isolated incident. It was a sign of something deeper, a debt bubble that's been inflating for years. Local governments, state-owned enterprises, and property giants have built enormous empires on borrowed money. And now, as growth slows, those cracks are starting to show. I spoke to a former colleague who moved to Shanghai a few years ago to work in the finance sector. He told me that behind all the shiny skyscrapers and booming infrastructure projects, there's a very real fear about how sustainable it all is. Entire ghost cities, built on speculation, sit half empty. Developers are scrambling to sell assets just to keep their heads above water. It's not the picture of unstoppable growth we're used to hearing about. And then there's the slowing economy. China's growth rate, once soaring in the double digits, has been steadily declining for years. The pandemic only accelerated this trend, and despite the flashy headlines about recovery, consumer spending and industrial output are nowhere near what they used to be. When an economy built on rapid growth starts to slow, it forces hard decisions. Where does the money go? Who gets bailed out? Who gets left behind? In my opinion, this is where China's long-term strategy gets complicated. Yes, they're diversifying investments and building a new financial order, but they're doing it while juggling serious internal risks. Risks that could undermine their ambitions if things spiral out of control. And let's not forget the social side of all this. High youth unemployment, an aging population, and increasing pressure on the middle class are creating tensions that aren't always visible from the outside. It's easy to focus on China's global moves, but the reality is that they're fighting battles at home too. Now, I'm not saying China's strategy is doomed. Far from it. They've proven time and again that they're willing to play the long game and endure short-term pain for long-term gain. But it's important to recognize that while they're building new economic bridges abroad, some of their foundations at home are under serious strain. So what does all of this mean for the global picture? On one hand, you have an America dealing with investment droughts and economic uncertainty. On the other, a China pushing forward while quietly managing its own internal storms. In the next part, let's take a step back and look at how the rest of the world is responding to these shifting dynamics. Because whether we like it or not, we're all connected in this evolving game. Stick around. When a giant stumbles, the rest of the world doesn't just sit back and watch. They adapt, and sometimes they move faster than anyone expects. Right now, as both America and China wrestle with internal challenges, a quiet but powerful shift is happening globally. Countries are rethinking old alliances. They're diversifying their investments, hedging their bets, and rewriting the rules of engagement. Let's start with the European Union. For decades, Europe leaned heavily on both the US and China for economic growth. But over the past few years, we've seen a deliberate pivot. European nations are strengthening ties within the EU, investing more aggressively in local technology sectors, renewable energy, and manufacturing independence. Just look at the European Chips Act, launched to reduce dependency on US and Asian semiconductor production, or Germany's new trade strategy, which explicitly mentions the need to reduce reliance on Chinese markets. And then there's India. In my opinion, India might be the biggest wild card in this entire reshuffling. They're attracting investment like never before, from American companies looking to diversify supply chains, from European firms seeking new growth markets, and even from Chinese capital in sectors that aren't politically sensitive. According to Bloomberg, foreign direct investment into India hit a record $85 billion last year, despite global economic uncertainty. That's not a coincidence. That's strategic realignment. Meanwhile, let's be honest, the US is losing influence faster than we like to admit. Allies who once reflexively followed America's lead are now carving out more independent paths. Saudi Arabia signing energy deals with China. ASEAN nations choosing to deepen trade ties with Beijing instead of Washington. Even long-standing partners in Europe are negotiating with both sides, hedging their bets. It's not that the world is anti-America. It's that the world is becoming post-America, a place where multiple centers of power exist and loyalty is based more on pragmatic interests than historic friendships. And honestly, who can blame them? When you see internal political divisions, economic uncertainty, and short-term policy making dominating the American landscape, it's natural to look elsewhere for stability. Trust isn't something you can demand. It's something you earn and re-earn, especially in times like these. In my view, this global shift isn't about America collapsing. It's about the world recalibrating. And if we're smart, we'll recognize it early, adapt, and find new ways to lead. Not by force, but by example. Because if we keep clinging to outdated assumptions about American dominance, we'll miss the opportunity to evolve alongside the new realities. Speaking of new realities, what does all this mean for you personally? How can we take these massive global shifts and actually use them to make better decisions for our future? That's exactly what we'll unpack in our final part. Let's bring it all together. As we wrap up today, let's take a moment to reflect on everything we've uncovered together. We saw how China's quiet, strategic freeze on outbound investments wasn't a random act. It was a calculated move, one designed to shift power without firing a single shot. We explored how the U.S. economy, especially its startup ecosystem and real estate sectors, is feeling the impact of that sudden capital drought. We looked at how China isn't standing still, but is instead channeling its investments into ASEAN countries and building an entirely new financial ecosystem with digital currencies and alternative alliances. We also peeled back the curtain to see that China itself is not invincible. Debt bubbles, a slowing economy, and internal pressures mean they're taking big risks too, even as they project strength abroad. And finally, we acknowledge the bigger picture. The world is changing, global alliances are shifting, new centers of power are emerging, and America's influence, while still powerful, is no longer guaranteed. But here's the most important takeaway. These aren't just stories about governments or billion-dollar companies. They are signals, warning lights and road signs telling us that the future won't look like the past. So what can you do? Diversify not just your investments, but your thinking. Stay informed, not just from one perspective, but from many. And most of all, think long-term, not just about today's headlines, but about where the currents are really taking us. Because those who can see the change coming and adapt will be the ones who thrive. If you found today's dive valuable and you want more real-world insights into how global finance is shaping your future, make sure to subscribe, hit that like button, and share this video with someone you think would appreciate it. This journey isn't over. We have so much more to explore together. Thanks for being here, and I'll see you in the next one.